Welcome to SALTovation. The SALTovation Show is a podcast series featuring the leading voices in SALT, where we talk about the issues and strategies to help you make sense of state and local tax.
Hi, everybody. It's Stacey from SALTovation, and I have a special guest with us today. You're not just getting the usual crew of us here at Tax Ops. I have Tim Noonan with me today, who's a partner at Hodgson Russ in New York. And he and I actually have had the opportunity to speak together recently for a private equity stakeholder group. And so we thought we'd invite Tim here to kind of talk about the things that he sees in his practice and kind of how some of these items or issues from a state perspective bubble up, not just for businesses, but also for the individuals that might own those businesses. But before we launch into that, I'm going to go ahead and let Tim introduce himself so that everybody knows who he is.
All right. Well, thanks, Stacey. Glad to be a part of this today. So yeah, I'm a tax lawyer. I'm not an accountant, so don't hold that against me. And practice is all state and local taxes. And it's all, of all shapes and sizes, represent a lot of high net worth individuals, a lot of businesses on income tax, corporate tax, sales tax, all sorts of issues, mostly in sort of the Northeast. But in the residency area, sort of the personal individual tax, that's been an area that our firm and myself in particular have focused a lot on. So both from a planning perspective, as most able-bodied New Yorkers have left New York in the past couple of years, so helping a lot of people move. But a huge part of my practice is defending taxpayers who are getting audited mostly by New York, but California, Connecticut, other states as well. But New York is the industry leader here, particularly in the residency space. So we handled thousands of cases of individuals who left New York, and New York didn't think they left. So defending taxpayers in those audits is a big part of our practice, and litigating cases. We've litigated some of the bigger residency cases in New York over the years. So lots of fun stuff.
Yeah, lots of fun. Yeah, fun.
Yes,
that's what we like to say. State local tax, right?
Sometimes it's actually fun, but
I hear it. I hear you. Again, I've been doing this a long time too. So we do have some things that some things are more fun than others, but again, we've been doing this a long time, both of us. So it keeps us busy and can be challenging too. It's like big puzzle pieces you put together. But so one of the things I just wanted to let the viewers know, like when we did this presentation, to our private equity stakeholder groups, a few weeks ago, it seemed that some of the things that came up in our presentation, not to mention, and I'll let Tim talk about this stuff, from his perspective in a little bit, but, just so that private equity firms know, if they're targeting certain companies, what kind of things might they need to look at from a tax perspective, from a state tax perspective, and some of the things we talked about was just nexus, right? Just where are those, target companies operating, and do they even know where they're operating? And I think both of our practices, we help companies with that. That's kind of like a, step one, right? Where do those targets have even filing obligations? And then, if they are flow-through entities, right, then the shareholders or, owners have obligations as well. And so I think those were some of the things that we, talked about in our presentation, as well as then just, what happens when you do in a private equity firm or in another, acquisitive kind of firm may acquire a company. What do you do from a sourcing perspective for the gain on the sale? Those kind of things, or so those are all kind of high, those are high points for companies that are looking to acquire. But I guess from your perspective, what are you seeing with some of your clients in that space?
Yeah, I mean, the state tax issues in private equity deals is sort of an underrated issue. Obviously, you and I think it's the most important issue because that's what we do every day. But we've gotten called in on both sides of these deals where someone's getting acquired and oops, they haven't collected sales taxes in the past forever years. So the private equity company that's buying them doesn't like that, right? We got to clean that up and figure out, have you been, are your sales taxable in this many states? And how do we clean that up through voluntary disclosure? So these state tax issues definitely can sort of rear their ugly head and not necessarily screw up these deals. I think the deals will happen regardless, but from the buyer's perspective, it's certainly something on due diligence where they're looking at. It's not 40, 50% federal tax, but 5, 6, 8, 10% taxes on billion-dollar deals is still a big number. So the buyers, counsel and accountants are digging into state tax issues on the due diligence side, and then when we've been again representing the sellers, we're just kind of playing defense sometimes, but you end up getting into debates with the buyer's counsel about whether something is taxable. Like the buyer's counsel sometimes takes on the role of the government to say, oh, you should have been paying tax in all these different states. So again, not anything that really screws up the deal, but just there's an expertise there for the SALT folks out there where they definitely have become needed in a lot of these big deals.
Yeah, no, agree. Yeah, because we also, at our firm, we also represent from an accountant perspective, buyers or sellers, and we see some of the same things, and I think go through and try to protect the buyers, and so that they are not stuck hanging holding the bag for some exposure that they are acquiring. But to your point, I don't think that it's always maybe top of mind, particularly when it comes to like transaction taxes. Maybe maybe they focus on the income taxes, right? Because those are maybe a little bit more prevalent or out there, because there could be third parties, other CPAs or whatever that are working on the income tax filings. But a lot of sales tax and transaction taxes are handled internally, so those may not be things that are always, at least where a buyer or seller has that much, or a buyer rather would have that much visibility to it.
Yeah. So, and look, with the Wayfair case in 2018, you mentioned Nexus. Like now you have all these sellers who might not be watching what happens at the Supreme Court level and don't realize that pretty much every state has come out and said, well, if you have a certain amount of sales in the state, which isn't very high a threshold, you should be collecting sales tax in 46 different states and thousands of local taxing jurisdictions. So that can be messy, particularly again, prior to the Wayfair case. Oh, we only have Nexus in one state or something like that, which was probably bogus too. Like it's not, doesn't take a lot to create Nexus. So lots of these companies on a multi-state basis probably had Nexus all over the place anyway. The Wayfair case just sort of made it obvious that, now we have Nexus like everywhere. And that's got to get cleaned up in these deals if the deals are going to go forward.
Well, and then, so that's, and so that's kind of like on the business side of it, right? The entity side of things. So then I guess kind of circling back to your practice, I guess, what are you saying if you're helping maybe some of those shareholders or individual owners, I guess, what are, other than maybe residency, kind of what are some of the things that you're seeing in your practice that they should be aware of?
It actually does. A lot of these questions will start with kind of the residency question. Okay. And it's, it's fun stuff for us because it's on both sides. Like, well, I have lots of clients who are selling their businesses and, they want to, maximize their take from the business, and state taxes is a piece of that. And then of course there's the folks who run these private equity companies who, I don't know if you've noticed, they make pretty good money too, right? So, the individual state income tax on the players in these companies is a big deal. So, but yeah, if someone's selling their company, I get calls a lot, which is, we're, got a letter of intent, we're going to sell. I live in New York City. My accountant just told me there's a 14% tax on my $100 million deal. That's $14 million. I don't want to pay that. We spent all this time in Florida already. Like, I don't want to pay the tax. So helping the sellers in that instance, just get out of town, like move, get themselves set up so that they're not a resident of New York or wherever, of California, when that deal hits. Like that's massive. So planning for those moves, has always been a large part of our practice. It's tougher when there's a transaction closing in 3 months and someone calls me and says, it's just happened the other day. I'm selling my company for $40 million. Transaction is going to close in Q1 2023. Okay, well, where are you right now? In my big New York City apartment. Like, do you have anything in Florida? No, I don't. Like,
all right.
Okay, let's get to work, right? So,
Yep.
But yeah, so that's sort of on the seller side. There's those issues, and then just like, well, how are states going to tax the gain on the sale, right? If the seller sells stock, then theoretically they only owe tax in their state of residence. What I've seen, and I don't know if this is just the deals I see, I don't really see a lot of just straight up stock sales, right? Like most people will sell assets. Or they'll sell stock, but the buyer will want a 330H10 election, so it gets treated as a sale of assets. So it's really sale of assets.
Yep.
Well, then, that seller might have, they could set up shop in Florida just fine, but they could have gain could be allocated to all these different states. So, and again, that actually sometimes becomes a negotiated point on the buyer side. I'm sorry, on the seller side in these deals. Like, wait a minute. I'm in Florida. If I sell stock, I don't pay any tax. You wanted me to sell assets. Well, now I got to pay tax in 46 states. What gives? So that becomes a negotiating point. Pay me more for my company because you're screwing me over. I got to pay all the state tax.
Yeah. No, absolutely. Absolutely. So from a residency perspective, because I mean, we have enough, work of our own here at Tax Ops about that. But I guess in your opinion, or I guess, do you feel like there's a lot of differences between like some of the states with respect to, I know New York's very aggressive, right? But I guess from a technical perspective on like the residency rules, do you feel like New York's a little bit more like they're a tougher state to claim or to prove non-residency than maybe another state?
Yeah,
I know that's kind of a loaded question because we sometimes get questions about like, is this state better than this state? And there's always gray, but
the rules in most states are either similar or really the same. Like someone leaving Colorado,
yes,
has the same sort of same residency test as someone leaving New York. There's a domicile test. There's like a day count test. Like so that. California's rules are a little bit different, but they all sort of sound in the same concepts of this domicile thing. So, in that sense, the rules are the same. I think New York, just being so aggressive, they don't have different tests really. They're more aggressive in enforcing those tests. The benefit is, because of that, and because there's such a long history in New York sort of fighting these cases, and there's like 300 tax auditors who do this work, there is lots of guidance out there as to what matters in these cases and what doesn't. There's tons of cases. Sure. There's 100 pages of audit guidelines where they sort of like the IRS has an audit manual. They have that for residency cases and non-resident allocation cases. It's awesome, right? So, I mean, you have all this material out there to sort of guide a practitioner when they have an audit. Whereas if someone leaves Colorado or something, it's like, well, there's no sort of wealth of precedent, so, and the reason is because, well, maybe Colorado isn't chasing people for the 5% or whatever tax there, so I just think that's the difference. It has allowed us to sort of practice, especially in residency, on a multi-state basis because of our experience just in dealing with the nuances of the residency rules that maybe haven't come up in a California case, but it's the same test. So we're able to sort of apply that knowledge and helping folks navigate some of these issues in other states.
Yeah, I could see that. Yeah, because I mean, and you got to think that even like a Colorado, which again may not be as aggressively pursuing, residency audits, at least today, right? They would potentially look to some of those others. I mean, and this happens all the time, regardless of, really what kind of type of tax it is or what the issue is, but they do look to other states for guidance as to, okay, how would they apply those rules, right? And we do the same thing in our practices.
Yep.
So,
for sure. Yeah. I mean, there's Connecticut is, their income tax is newer. It was been in place since the 90s, but there's tons of Connecticut income tax cases where the court says, well, we don't have anything on this, but there's a case in New York, and since our laws are similar, so there's in some instances it's flat out reliant on what happens in New York. So that's all helpful kind of knowledge and guidance as we're helping people manage these issues in other states too.
what would be kind of like your like takeaway for like, it doesn't even have to be like in a private equity firm who might be like going to look to acquire, but any kind of like acquirer, kind of what would be kind of like the takeaway from your perspective for them to, if they're looking to acquire a company?
From the sort of the private equity side of things?
Yeah.
Well, I mean, so there's two aspects of it. One is, what we talked about initially, which is make sure you're not buying a bag of goods that's got state tax problems up the yin yang. You know what I mean? Like, so,
Yep.
obviously you got to do your due diligence there. I mean, that's, from the state tax perspective, that's what those folks need to have in mind, just like we discussed. And you get good accountants and lawyers to do your due diligence, and you might find a lot of stuff under the rocks you uncover, but at least you're doing it before you buy the company and you ride off into the sunset. The sort of taxation of this, we talked about in our seminar last week, that the taxation of sort of private equity owners is interesting because they often will benefit from the sort of carried interest kind of concept, where a lot of their, they'll have management sort of fee income, and management fee income is taxable in states where the work is being done, even if you're not a resident of that state. But, a lot of the sort of wealth creation that happens for folks in the private equity world is through sort of pieces of their target companies they acquire. And then when they sell, again, it's whatever that's called. I call it carried interest, but it's sort of their piece of these companies. Well, that is almost always just treated as investment, as capital gain. Yeah. It's an intangible. So in addition to the sort of the capital gain benefit of carried interest, which is a long tortured thing about whether or not hedge fund folks and private equity owners should get sort of capital gains treatment, it has an important effect on state taxes too, because even though, I mean, particularly like in the hedge fund context, where you have the hedge fund owners receiving management fees and sort of incentive fees for their services, but yet the incentive fees are capital gain, and the incentive fees aren't taxed in any non-resident states. It's the same thing with the private equity folks who sort of sell, have huge income events from the sale of a target. Well, they're not paying any income tax themselves personally on their piece in any states except the state where they're a resident. So then the issue for them, so on both sides, you could have, both sides of the deal where buyer wants to get out of New York and seller wants to get out of California before this transaction happens to save 14% taxes. So you'll have both of them trying to leave. So the similar issue will, come up on this buyer side, on the private equity side, just making sure that there's a real benefit to be had if you're living in a no or low tax state. So that's a consideration that always comes up for those folks as well.
Yeah. Okay, good.
Yeah.
Yeah. And I guess, we've kind of been talking about the private equity space, but I guess, one of the things that I think we as a firm do, and I'm sure that you guys do too, right, is, when we even maybe get a new client who's, maybe they've been, operating for a few years or whatever, we always ask about, hey, are you entertaining some kind of exit strategy? And what is that going to be? Back to your point about planning, because it's really important for things to be put in place for them to, have the best tax outcome should they decide to sell. So
yeah, I mean, I was just working with a client this week, and he was closely held company, S corporation, and he had sort of engaged us to help him move into Florida. Wanted to make sure that sort of the way his income from this S corporation was taxed, was most tax efficient, wasn't taxed in New York. And in looking at the sort of shareholders agreement and such, we're like, well, problem here is what you have set up. Like, forget about the New York thing. New York thing's great. We got a good plan. But if the IRS ever looked at this, like they'd void your S election, right? So they were basically paying out all the salary to the owners, and it wasn't great. It's a little, that kind of stuff is kind of outside my wheelhouse, but I grabbed one of my federal tax partners, and he was like, yeah, this is super bad from an S election standpoint. But they've been around for decades and no one's ever raised it. And, a client was like, okay, well, thanks for pointing that out, but, what am I going to do about it? Like, it is what it is. And who cares? Because, the IRS hasn't brought it up. New York's probably not going to bring it up. But the issue was, do you want to sell? Oh yeah, we might sell in 5 years. Well, I tell you what, that buyer is not going to be happy that the company it's acquiring has had a blown S election for 20 years, right? So knowing sort of the long-term picture becomes super important in situations like that.
Agreed.
Yeah.
Okay.
Yeah. Okay.
Okay. Well, thanks everybody for joining us today on SALTovation, and a special thanks to Tim for joining us as our special guest. And we'll catch you next time.
All right. Thanks for having me.
This podcast is for educational purposes only and is not intended, nor should it be relied upon as legal, tax, accounting, or investment advice. You should consult with a competent professional to discuss specifics of your situation and the applicability of the information presented.